Hi. Let's learn about forward price to earnings, forward P/E. Forward price to earnings is a version of the ratio of price to earnings, P/E, that uses forecasted earnings for the P/E calculation. While the earnings used in this formula are just an estimate and not as reliable as current or historical earnings data, there are still benefits to estimated P/E analysis. The forecasted earnings used in the formula are typically either projected earnings for the following 12 months or the next full-year fiscal period. The forward P/E can be contrasted with the trailing P/E ratio. For example, assume that a company has a current share price of $50 and this year's earnings per share are $5. Analysts estimate that the company's earnings will grow by 10% over the next fiscal year. The company has a current P/E ratio of $50/5 equals 10x. The forward P/E, on the other hand, would be $50/5 by 1.10 equals 9.1x. The forward P/E is smaller than the current P/E since it accounts for future earnings growth. Analysts like to think of the P/E ratio as a price tag on earnings. It is used to calculate a relative value based on a company's level of earnings. This method helps to determine what the relative value of a company will be at a future level of earnings. If the forward P/E ratio is lower than the current P/E ratio, analysts are expecting earnings to increase. If it is higher, analysts expect a decrease in earnings. Forward P/E uses projected EPS, projecting a company's future valuation. Meanwhile, trailing P/E relies on past performance by dividing the current share price by the total EPS earnings over the past 12 months. While some investors prefer to look at the trailing P/E due to its objectivity, others acknowledge its shortcomings, as past performance does not necessarily signal future behavior. Since forward P/E relies on estimated future earnings, it is subject to miscalculation and bias. Companies can underestimate or overstate earnings to influence their forward P/E. If using forward P/E as the central basis of your investment thesis, research the companies thoroughly and consider both forward and trailing P/E. In Microsoft Excel, you can calculate a company's forward P/E for the next fiscal year. The formula for the forward P/E is simply a company's market price per share divided by its expected earnings per share. By comparing forward P/E ratios between companies in the same sector, you can gain insights into their relative valuations. Here are 3 key takeaways. 1. Forward P/E is a version of the ratio of price to earnings that uses forecasted earnings for the P/E calculation. 2. Because forward P/E uses estimated earnings per share, EPS, it may produce incorrect or biased results if actual earnings prove to be different. 3. Analysts often combine forward and trailing P/E estimates to make a better judgment. Hope this would help. Thanks for watching.